All right, let's talk about something that can sneak up on any international startup, a hidden threat that works in the shadows of every cross-border deal. I'm talking about foreign exchange risk, or FX risk. We're going to break down exactly how it can impact your valuation and, more importantly, what you can actually do about it. Okay, I know what you're thinking. A bit traumatic, right? But honestly, for any company working across different countries, this isn't just some scary headline. A sudden swing in the currency markets can literally wipe out months of progress and, yes, take a huge bite out of your valuation. So how on earth does that happen? So what are we really talking about here? At its heart, FX risk is just uncertainty, pure and simple. When the value of, say, the euro changes against the dollar, it messes with everything. The money you're earning, the bills you're paying, and crucially, how investors see the stability and the real value of your company. All right, let's pull back the curtain on this unseen valuation killer, because it's way more common and, frankly, way more destructive than most founders even realize. And look, this isn't some rare niche issue that only affects a handful of companies. We're talking about a massive 80%. That's right, 80% of international small and medium-sized businesses say they've been hit by FX risk. And for a startup running on a tight budget, taking those kinds of hits can be absolutely brutal. Okay, now here's where things get a little weird, a little counterintuitive. You'd think a strong home currency is always a win, right? A strong dollar, a strong economy, all good stuff. But if you're making money in other countries, a stronger dollar actually means that when you bring that foreign revenue home, it converts into fewer dollars. Your profits literally shrink on paper. And this table just lays it all out perfectly. Let's just walk through it. Imagine you're a US-based startup and you've earned a solid €500,000. Great. When the exchange rate is €1 to $1.20, that's $600,000 in the bank. But what if the rate shifts just a little bit, down to $1.10? You still earn the exact same €500,000, but now it's only worth $550,000. Just like that, 50 grand has vanished from your top line. So, those little shifts can sting, but what happens when the market goes, well, completely haywire? This is where we get into the real cost of volatility. This is where the risk becomes something you just can't afford to ignore. I mean, just try to wrap your head around this. In 2023, for startups in Nigeria, the Naira surged an absolutely mind-boggling 205% against the US dollar in a single year. Can you imagine trying to plan your budget, your payroll, or your runway when your currency is on a roller coaster like that? It's not just an accounting problem, it's an existential one. And you can bet that kind of chaos spooks investors. Big time. In fact, research shows that just a tiny 1% increase in currency volatility can cause foreign investment to drop by 15 to 20%. And why is that? Because if investors can't trust your financial forecasts, they're either going to demand a lower valuation or they're just going to walk away. You want a cautionary tale? I mean, a real what not to do story. Let's talk about Laker Airways. Back in the 70s, they took out huge loans in US dollars to buy their fleet of planes. The problem? They were a British company, earning in British pounds. So when the pound took a nosedive against the dollar, the real cost of paying back those loans basically doubled. The debt became an anchor they couldn't escape, and it dragged the whole airline down. It's a textbook example of a fatal currency mismatch. And that's the perfect lead-in to what every founder lives and breathes: fundraising. Because if you're not careful, FX risk can directly attack your funding round and burn through that cash you worked so hard to raise. And this, right here, is where it hits home for founders. It's about your runway, the very lifeblood of your company. Say you're a UK startup and you raise a big round in US dollars, but you spend in British pounds to pay your team and your rent. Well, if the pound strengthens against the dollar between when you sign the term sheet and when you actually spend the money, your 18-month runway could suddenly become a 16 or even 15-month runway. Months of survival, gone. Okay, so we've established the problem. The risk is real, it's scary, and the stakes couldn't be higher. But, and this is a big but, you are not helpless here. Now we pivot from the problem to the solution. It's time to talk about the actionable toolkit you can use to tame this currency beast. And before we jump into the tools, I think this quote from Chris Braun at US Bank just nails the mindset you need to have. This is not about being a currency trader. It's not about trying to time the market or make a quick buck. It's about defense. It's disciplined risk management, plain and simple, to protect the value you're building. So where do you start? The very first line of defense, and honestly the smartest one, is something called natural hedging. The concept is incredibly simple. Try to match the currency you earn with the currency you spend. So if you have a lot of revenue in euros, maybe set up an office there and pay your local team in euros. And a super simple part of this is just using multi-currency bank accounts. The whole goal is to reduce how often you have to swap currencies and expose yourself to those market swings. Okay, so natural hedging is great, but sometimes it's just not possible to perfectly align everything. That's when you bring in the financial toolkit. The two big ones you need to know are forward contracts and currency options. Think of it this way. A forward contract is all about certainty. You agree today on an exchange rate for a transaction that will happen in the future. You're locked in, no surprises. A currency option, on the other hand, is about flexibility. You buy the right to exchange currency at a certain rate, but you don't have to. So it protects you from the downside, but you can still benefit if the rates move in your favor. And this isn't just theory. Businesses are really starting to wake up to this. This data shows that U.S. businesses are now hedging almost half of their total currency exposure, and that number is climbing quarter over quarter. It's a clear signal that just crossing your fingers and hoping for the best is no longer a viable business strategy. So what's the big takeaway here for you as a founder? It's simple. Bake this into your financial models. Don't just show investors one forecast with one exchange rate. Show them you're prepared. Model out a best case, a base case, and a worst case currency scenario. It proves you understand the risk, you respect it, and you have a plan. All right, let's boil this all down. What does this really mean for you and your startup? What is the founder's bottom line here? Look, here's what you need to remember. 1, if you're an international company, managing FX risk isn't a nice to have, it's a must do. The impact is real. Even a 10% swing can destroy a VC fund's returns from your company. 2, start simple with natural hedging. 3, as you grow, learn to use tools like forwards and options. And finally, and maybe most importantly, this is not a one-and-done task. You have to be constantly watching and adapting. So, I'll leave you with this one last question to chew on. After everything we've just gone through, take a hard look at your own cash flow. Are you really accounting for this stuff? Because if the answer is no, your runway might be a whole lot shorter than you think.